Thanks for coming to listen to me chat about my side project. Before I dive into how women are conquering the S&P 500, I want to give you a little bit of the backstory about why I started this. That is a very large photo of me. I am the VP of product at Quantopian. Quantopian is a company that's going to become the world's first crowdsourced hedge fund. And what we provide to our users is a platform that lets them research, test, and trade algorithms to invest in the market. And we're going to invest in the best of those. I'm the VP of product there, and I'm a software person. I've spent my career working with engineers to build software. I've built marketing software and content publishing software and commerce software. I have never traded algorithms on the market, and I've never built for quants, and I've never worked with quants before. So one of the really important things for me to do as a product manager of a tool that is going to be built and used for quants is to understand what quants do, which means I need to write algorithms that invest in the market. So I brushed up my programming skills and dove in, and as I was trying to figure out what I was going to write about and what kind of algorithm I should do, Credit Suisse released their Gender 3000 report. And the Credit Suisse Gender 3000 report is a study that they did that looked at 3,000 companies in 40 countries and how gender was reflected in those organizations. And they found some interesting things. They identified that 12.9% of top management is women, and that 12.7% of the boards have a female on them. Now, these numbers are very low, but I don't think they're surprising to any of them. We know that these numbers are very low. Some of the other charts that they showed that I thought were really interesting were this one, which looks at the global performance of companies who have one or more women on the board, which is the gray line, or no women on the board, which is the blue line. Well, that's interesting. The next one took a look at the performance of companies based on the percentage of women on the management team. So the purple line is companies with 50% females on their management team. Gray line is 33%, blue line is 25%, and the green line there is all companies. So these charts lead you to think that, companies with women in management on the board, they perform pretty well. And all of this led me to the question of, well, what if you invested in female CEOs? And my initial idea was very simple. I could create an algorithm that would buy when a female CEO came into the position and sell when she left. And that seemed really simple. It seemed like something I could do. And so that was the path that I decided to head down. So about the same time we were working on this, we were building a brand new research platform for our users. And it's a hosted IPython notebook. So I don't know if you guys are familiar with IPython, but it's a great platform that allows you to kind of explore data, use code, and visualize it in some really easy and neat ways. And it's got access to all sorts of data that Quantopian provides, and all of this work is done in IPython notebooks. They're actually all shared to our community, so if anybody's interested in exploring them further after this talk, you can. But I've done it in slides because they're easier to present. So the first thing I did was have to find data. Always a perennial challenge when you're trying to do something like this is, where do I get the data? And what I needed was a historical list of female CEOs, because if you look at just the CEOs that are females today, you're not going to be able to determine if the historical performance was because the female CEOs are there today. So I needed to understand the female CEOs of the past. And so I Googled, historical list, female CEOs, and I found Catalyst, which is a nonprofit focused on expanding opportunities for women in business. And they publish a bottom line report every year. And this report basically looks each year at the Fortune 1000, and it identifies all of the female CEOs of the Fortune 1000. And it does this going back 10 or 20 years. Our system has data from 2002 until the present. So I needed to understand the historical CEOs back to 2002. So I went through this list and I copied down all those CEOs' names. And then I needed to know when they started their position and when they ended it in order to implement my algorithm, buying and selling based on those dates. So I spent a good chunk of time Googling every single one of these female CEOs and digging through their bios to figure out the exact dates that they started and ended these positions. It was quite tedious. I'm sure if you've done anything with data, you understand how tedious that can be. And then I needed a ticker symbol. And then I had to do a whole bunch of data cleaning, because here's the thing about CEOs. They're not like you and me. They don't start their job on the Monday 2 weeks after they quit the last job. They start on the first of the month or the first of the quarter or the first of the year, and these dates are often not trading days. So I then had to adjust for which days were trading days, and companies get acquired or they merge or they go out of business, and I needed to figure out how all of those dates aligned with these CEO dates. And ticker symbols, they're not unique. They get reused. So you have to make sure that you've got the right ticker symbol for the right company, and companies can just change their ticker symbol for marketing. And so there's a whole bunch of just mapping that had to happen to make sure I had the right data. I guess that I estimate that I spent about 30% of my time early on just cleaning this data. Fine, I've got my data set. At the end of that, what I've learned is that there are 80 female CEOs in 74 companies in the Fortune 1000 across the 12-year period from the beginning of 2002 to the end of 2014. Now, I've shared this research on the internet, and one of the pieces of feedback I often get is that my sample size is too small, which is spectacular because yes, my sample size is too small, but it's also reality, and I cannot change the gender of CEOs of the Fortune 1000. So this is what we have to work with. So the next thing I did was just pull it into the IPython notebooks and do some visualization. So this is the number of new CEOs per year over the 12-year period. And you'll notice, or maybe you can't read this because it's so small, this starts actually in 1998 because I also included CEOs that started prior to 2002 but were still a CEO in 2002. So on the first day of my simulation, I could buy those CEOs knowing that they were already in the position. So I'm happy. This is actually trending in the right direction for me. There are more female CEOs towards the end of this, so that seems like a good thing. I was a little bit interested in wondering if, trying to determine if I was going to have enough data. Part of the reason that I looked at this is the market, I'm not sure if you're aware, but it's been going gangbusters since 2008. And so if all of the female CEOs had been CEOs from 2008 to today, what would that look like? And then I looked at the data and I was like, I don't actually know what that would look like, so I guess I should just write my algorithm. So I moved on. So let's take a step back and talk about what it is exactly that I decided to model. What I was doing here is called a backtest in algorithmic investing. And you write an algorithm and then you have historical pricing data about what happened in the market in history. And you simulate what would have happened if your algorithm was making trading decisions for you. So for every day from January 1st, 2002 until December 31st, 2014, my algorithm goes through and it does a couple of things. It first asks, looks at my list of 80 female CEOs and says, did anybody start today? Anybody start their job today? And if the answer is yes, they put them in a buy list. Then it says, did any CEOs end their position today? And if the answer is yes, it puts them in a sell list. And then it rebalances. It basically says, how many female CEOs do I need to hold? And then it takes a look at my portfolio value, and it divides that evenly by the number of female CEOs, so I invest the same amount in every company in my portfolio, and then it moves on to the next day. And it marches on through history, making these buy and sell decisions based on the data that I collected about when these female CEOs started. And what it's giving me is an idea about what would have happened in history if I had invested in female CEOs. Sound good? All right, nodding heads, that's excellent. So this is how many companies my portfolio will hold each year of the simulation. So in 2002, I've got about 13 companies, and by the end of it, I'm holding about 50 companies. So that equal weighted portfolio at the end of this is taking the value of my portfolio and dividing it into 50 chunks and assigning 1/50th to each company and investing 1/50th. That's going to matter in a minute. I'll show you an example of why that is important. So when we take a look at that, this is what my algorithm looks like. I'm not going to go into the code. Again, it is all available online if you want to read more about it. And these are what the results look like for the first simulation. So the green line is my algorithm with 339% returns, investing in the female CEOs of the Fortune 1000. The blue line is the S&P 500, and my algorithm outperforms the S&P 500 by 217%. As a first-time algo writer, I was pretty thrilled at these results. I also thought I had made a whole bunch of mistakes, and I spent a bunch of time analyzing it and evaluating it and getting other people to look at it with me to work on it, and then I shared it with the Quantopian community. Because what we have is all of the quants in our community work together with each other and share algorithms and get feedback. And they were wonderful. They taught me about things like leverage, which is when you borrow a whole bunch of money in order to fund your algorithm. And when you're running a simulation, you can get into a situation where you have just borrowed a whole bunch of money and put yourself in debt, and your returns look great, but all you've done is put yourself in a lot of debt. This is not over-levered. It has a leverage of about 1, which basically means I'm almost borrowing no money at all. We talked about things like Sharpe ratio, which is volatility. And so understanding how volatile an algorithm is, which is important when you're thinking about investing in it. You want something that's not as volatile. And anyway, I got a lot of interesting feedback and a lot of ideas about what I could do next. I'm going to run through a bunch of different things, but generally at this point there's a bunch of questions. Does anybody have questions about what I did here or how this algorithm works? There's a microphone. Don't be shy. All right, awesome. So that's the first thing that I did. Questions that I got were things like, could it be Yahoo and Alibaba? Why might it be them? So this is a chart looking at Yahoo's stock price over this 12-year period. Yahoo had 2 female CEOs in my list of 80. The first one's Carol Bartz, here, not a lot of change. The second one, Marissa. And so look at the stock price since Marissa's been CEO. That's pretty spectacular. The reason that's so spectacular is because Yahoo made an early investment in Alibaba, and Alibaba IPO'd, if you remember, during this time period. And Alibaba had quite an impressive IPO. And so everybody knew that Yahoo had made this investment in Alibaba, and as Alibaba's stock went up and up and up, Yahoo's stock went up and up and up too. So the theory that people were saying is your algorithm just performing really well because it holds Yahoo? It's a totally fair question. The beautiful thing is, it's really easy to just say, doot, 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 remove Yahoo, run my simulation again, and what does it look like? So this is my algorithm without Yahoo, 320% or 197% difference. And so the reason here comes back to that chart where I showed you how many CEOs I held in my portfolio at any given time. Because at the end of the portfolio, Yahoo only represents like 1/45th or 1/50th of my overall investment strategy. And so while it has an impact, it is not a sizable impact on the overall returns. Other things we talked about was sector bias. So I've selected these companies that I'm investing in entirely based on the gender of their CEO. But they could all be in one sector. And so we have Morningstar fundamental data integrated into our system, and with that data, I was able to get the sector codes of all of these companies, and then this is a plot of the 80 companies by sector. Sorry for the small font. These 2 here in the middle, this nice tall one and the one next to it, that's consumer defensive and consumer cyclical. They represent roughly 30% of my portfolio. And so the theory here is, if the consumer sector was doing great during this 12-year period, my algorithm could be doing great just because it has an overweighted investment in consumer companies. So what I have to do here is create a sector-neutral portfolio. And this one gets a little bit complicated. Instead of taking my total portfolio value and dividing it by the number of companies in my portfolio, I look at the companies in my portfolio, I look at how many sectors are reflected in those portfolios. This is each time I rebalance. I then take my portfolio value and I divide it by the number of sectors that are there. Then I take each company one by one and I say, which sector is this company in? And how many companies are in that sector? And if it's something like healthcare here, which has 3 companies, I say, okay, take the amount allocated to that sector and then divide it by 3, and that's the amount I invest in this company. And if it's a consumer company here, I say, okay, there are 20 companies in this sector, take the amount allocated to the sector and divide it by 1/20th. So some companies have a lot more invested in them than other companies, but each sector has the same amount invested in it at all times to neutralize the impact that any one sector has on the overall outcome. Make sense? When we do this, it looks like this. Performance comes down to 275% over, in total, 153% over the S&P 500. So again, still sizable returns, not totally due to sector bias of the consumer industry. So one more thing that I've kind of neutralized in terms of thinking this could be the reason why I'm seeing this amount of outperformance. The next one we took a look at is, and I'm still hearing this morning I shared this again with our community, you are using the wrong benchmark. This is a very interesting philosophical question. S&P 500 is used as a benchmark across all of finance. The mutual funds in your 401k, they are benchmarked against the S&P 500. Hedge funds in the industry are benchmarked against the S&P 500. The S&P 500 is the benchmark of choice. It's made by Standard & Poor's, S&P, and it's supposed to reflect the US economy from large cap companies. And what they do is they look at companies that have a market cap of, sizable market cap, have a certain amount of liquidity, they've got a couple of things, and then a board decides whether or not a company belongs in the S&P 500 or not, and they choose when someone gets added or kicked out. So how and why and all of those things, it's a little bit murky, but this is the benchmark of the industry. That's fine. A benchmark that would be better for my algorithm might be the Fortune 1000. Now I'm looking at female CEOs of the Fortune 1000. If I were to compare it to all companies of the Fortune 1000, we could see if the female CEOs are actually outperforming everyone else. Make sense? The challenge here is that one of the way Fortune makes money is by selling you the historical constituents of the Fortune 1000. So if I wanted to create said benchmark, I have to pay them thousands and thousands of dollars to get the lists every year of what the Fortune 1000 is, and then create some kind of strategy to get that imported into my system, invest in those companies. It's a whole other algorithm by itself. For my side project, in order to learn about my customers, this was not going to happen. The thing is, in some ways, as a product manager, this algorithm is the gift that keeps on giving. Because I've been working on this in the spring a whole bunch, I'd put it aside, and I decided, then we were working on a bunch of other things, and it was 2 weeks ago as I was getting ready for this presentation when I realized we had built a new API that let me simulate the Fortune 1000, and I hadn't even realized it. I was working on a product, and I was very excited. And so the new API allows you to take the entire universe of securities, so that's 8,000 securities in the US equity market, rank them based on any factor you calculate. And so for me, I was just ranking them based on revenue, because the Fortune 1000 is the 1,000 largest companies by revenue, and then invest in just the top 1,000. And the way my algorithm to represent the Fortune 1000 works is it takes those 1,000 companies and then it rebalances that every month. So every month it does the math again. What are the top 1,000 companies by revenue? Pick that list and then invest equal weighted in those. I went back to the equal weighted approach for this. So I created my own Fortune 1000. Now the slight difference is the Fortune 1000 technically includes private companies as well, where their data is public. Those ones are not in my simulation, but these are my simulated version of the Fortune 1000, which I affectionately call the Quanto 1000. And here it is. The red line is the Quanto 1000. The green line is my algorithm, the female CEOs of the Fortune 1000. Blue line is the S&P 500. So this actually gets really interesting. Here are the results. So my algorithm is 339%. The Quanto 1000 is 296%. So there's a 43% difference there. And you can see that the red line, it tracks much more closely to my algorithm than the S&P 500 does. So this does appear to be a much better benchmark than the S&P 500. However, my female CEOs, they still outperform. And so that's really interesting. And I don't know the reasons. Causation, correlation, all of those good things. Like, are they female? Is it something totally different? I'm not sure. I continue to explore this and try and figure it out. But in this particular case, when I look at a different benchmark, my Quanto 1000, we're still outperforming. Now, I shared this was some new stuff that I worked on the last couple weeks. I shared it with our community today, and somebody was like, yeah, that's still the wrong benchmark, and they gave me another one to try. So there's another ETF that I'll be running against to see. It's interesting. That is one of the key things that keeps coming up in this research, and I really liked this one. I was excited about it. In any case, the next thing that after this, so this is interesting. Fortune 1000 beats the Quanto 1000. What if I take out the Fortune 1000 restriction on this algorithm? I want to look at all CEOs. Now, obviously I would have started there if I had that data from the beginning, but the data I could find was the historical list of the Fortune 1000. And then this is a standard problem when you're doing this kind of research, getting the data. And for our users, this is a problem for them too. We provide them with the pricing data to run these simulations, and we provide them with Morningstar fundamentals data, which is 600 data points for every company. You'd think it would have everything. It does not have gender. And so that's been one of the things for me, is that I cannot, in our data sets, do this. And recently, one of the projects we've been working on is providing more data to our users. Again, this algorithm is the gift that keeps on giving. And in those data sets, one of the interesting things that we can do, because we have this massive community of users who use our system on the internet, it's all a SaaS-based platform, they never download it to their computer, data vendors are willing to put their data in our system knowing that the users cannot steal it and give it to their brother or their friend or anything like that. And so institutional grade data, which costs thousands and thousands of dollars every year to buy, can become very cheap on a platform where the users can't steal it. And so we launched a store the other day with a CEO change data set from EventVestor, and it has gender in it. Now this data set's really interesting. It is not just female CEOs. It is every CEO change that has happened from 2007 to today. So anytime a CEO changes at any company in the United States equity market, it's mapped in this system. And they have way more information than I had. They do have the gender of both the incoming CEO and the outgoing CEO. They have the reason for the change. They have whether or not the new CEO came from internally or externally. They also have the date the change was announced, the date you could trade on the information, and then the date it became effective, when the CEO actually moved into the position. So much that you can look into with this. We had a spectacular intern this summer, James Christopher from the University of Washington. He is across the country now back at school, so he could not be here today, but he spent months like digging through this and running all sorts of different simulations to help me try to understand what's going on. And I cannot run you through every simulation that James and I did over the summer, but I have a few to show you. So this I'm showing because this does not look like the other charts I've shown you, does it? One of the things this set allows, because it has females and male CEO changes, is I can do an algorithm of the female CEO changes as compared to an algorithm of the male CEO changes, where the buy-sell decisions are based on the same criteria. So the blue line here represents buying when female CEOs start the position, so on that effective date, and selling when they end. And the green line is the same thing for the male CEOs. And you'll notice the performance here is kind of the opposite of what we've been seeing on these other charts. Now, it looks like they end sort of the same place, but you'll notice there's a dip right there on the female CEO. And so this was one of the things that I used the effective date initially because the effective date seemed most similar to what I had probably found on the internet hunting for the Fortune 1000 CEOs. But I first saw this and I was like, wow, that's pretty interesting. And James started looking at all the different dates that were available in our system. This is another version. This one buys on the announcement, on the day that it's announced that the CEO is changing, and sells when it goes into effect. On average, there was a 20-day lag between those two things. And when we do that, the female CEOs outperform the male CEOs. And so he was actually able to plot that when female CEOs were announced, there was this dramatic dip in the stock price that rebounded fairly quickly. And if you invest leveraging that dip that happens based on the announcement of an incoming female CEO, you can make some outsized returns. However, when you plot this then against the S&P 500, you'll notice it doesn't actually compare all that well, and you're not making massive returns, you're just beating the male CEOs. These actually, they're about 1% difference, but once you round them, they end up looking exactly the same. When I add, though, my Fortune 1000 CEOs to the same chart for that same time period from 2007 to today, those Fortune 1000 female CEOs are still outperforming pretty sizably over both the female and the male CEOs from the entire universe of securities, as well as the S&P 500. So where does this leave us? I would love nothing more than to stand up here and tell you conclusively that female CEOs are outperforming male CEOs. I am 100% biased in the research that I am doing. I do not claim not to be. I have just shown you so many different scenarios, and so many times during this project do I stand at my computer looking at it and saying, what is this telling me? The reality is there's a lot of interesting data out there, and I expect in algorithmic investing, you rarely know for certain if your strategy is going to be a moneymaker. There's all sorts of things we do to try and determine the answers to these questions. I have more study that I want to do. Where I'm at right now, I think there's something interesting about female CEOs still. I think it probably has something to do with market cap and revenue, and if I can look at that overall EventVestor data combined with market cap and revenue to take the top market cap and revenue companies and then the ones with female CEOs and look at how that performs, there's a lot of interesting things there. All of my work is at quantopian.com/female CEOs. It's all in IPython notebooks, and all of them are shared there so you can go through this. And if you have an interesting way to extend this work, I would love for you to do that so that you can show me what you think, and maybe you can conclusively show that female CEOs outperform their male peers. Because really, that's what this is about. Quantopian is about giving data and tools to people anywhere so that they can ask and answer these kinds of questions. Because in the hedge fund world, this information and this tool set has been locked within a very small subset of our population and not given to everybody. And at Quantopian, diversity is going to matter a lot to us. You see, we're at the intersection of two very interesting industries, finance and technology, both of which are woefully lacking in female participation. But we want to be a crowdsourced hedge fund, which means we're banking on the fact that if we get algorithms from a diverse set of the population, we will have more interesting things than the guys on Wall Street. And there are ways in which we're just kicking ass at doing this. We have 50,000 users. 50% of them are not in the United States. More than 60% of them do not work in the world of finance. So we have exceptional diversity in our community from those perspectives. We also have great diversity of data available to our users. But by my estimations, less than 4% of our user base is female. And the reason I get up here and I show the work that I'm doing is because I want all of you to come join our community so that when we change Wall Street, because we will change Wall Street and the way they think about quantitative investing, we also change it by having more female quants than any other hedge fund out there. Thank you very much. That's me.
We have time for questions, if anybody's got any questions. There's a microphone in the middle. If you ask any microphone, you'll be able to hear you. I think that's super interesting, and of course I think that women are superior at everything. Just kidding. So do you think that the lack of opportunity is one of the reasons is driving this? That, because often you'll say as a woman or someone who's underrepresented, that you'll have to be twice as good as your male counterpart. So do you think that as we have more and more women as CEOs that we'll all suck equally, or?
It's interesting. I have no idea exactly what's happened. There's lots of theory out there that you see this type of thing because the women that do get to the top are the very best of the best. They have to fight so hard to get there. And if you believe that theory, then yes, at the point where at 50% female CEOs, 50% male CEOs, the performance should be the same. And I expect that will probably happen. I'm more than happy to show the difference between now and there, to point out the fact that there is this dynamic, but I think that it's probably likely that once it's 50-50, it's all equal. Anyone else? No, none of you guys want to question my theories? I'm totally biased. Yeah.
Not questioning your theory, I was just curious why you had that really nasty drawdown in 2007-8 with the female CEOs relative to the S&P. Just go back further. In fact, go back to your first chart. Yeah, you see that really nasty drawdown, the green one.
Yeah.
Relatively, why was it? I'm just curious why the companies with female CEOs did particularly badly then.
It's actually, this is 2008.
Right.
Yes. And so I actually have not dug into exactly which stock or stocks are the cause of this one. However, I do know that the portfolio size at this point is not that large, so any individual company could have a larger, more sizable impact on it. It's actually it's more volatile in the early years because there are so few companies in it, but I do not know which company or companies are responsible for the massive drawdown there. It's an interesting question. One I think I could probably find out the answer to, worth looking into. There was another one that I noticed actually here, this in the Quanto 1000. There's a nice drop there that I have no idea what caused that. So I'll have to dig into that one as well. You do see the same actual sizable drawdown here in the Quanto 1000. 2008 was a fun time, right? Yeah.
I'm a little short for this. So sorry if I missed this, but are you still collecting the data in an ongoing way and cleaning it and everything?
Yeah, so I haven't been. I'm waiting for the next Catalyst report to get released. That's the problem. They release it annually, and so I don't have the next version of it yet. And at that point, I will go and get the next batch of CEOs to add to it because it's just one more year for 2015, which is why everything ends on my simulations at the end of 2012. One of the interesting challenges here is if I did want to live trade this, say I wanted to use this in a hedge fund, I would need that live data on a very timely fashion. And I've talked to 3 or 4 actually funds that are based on, they call it a gender lens, basically using a gender lens to make investments. And getting the data and knowing when a CEO is male or female is one of the biggest challenges. A lot of it's done based on name recognition and trying to plumb through it. And all of them have told me that they first do a first pass of some kind of automated filtering and scanning of press releases, and then have humans review it because the automated processes are only so good, especially with international names. And so I don't have a data feed. The EventVestor stuff does get updated on a more frequent basis. I'm not entirely certain how frequent it is, but I mean, it depends on how quickly they get the data into their system. But that one, in theory, is a much closer one for me to be able to invest on. Of course, with some of those early returns, I wouldn't want to do it based on the full set of data there, so I need to figure out how to winnow it down to what I think is an outperforming algorithm.
Okay, yeah, just because that would be great if you eventually get this to a live feed and you can expose an API, because then people can come in and use R, Python, whatever their tool of choice is.
Absolutely.
So I'll definitely watch for that.
So I have the EventVestor stuff is all available in our system via API, so you can just pull that data in and start looking through it. It's actually all free except for the most recent stuff, so you can access all of that without paying for anything. My data set is available at like a Google Doc link. So anybody can take that, and if you want to update it for the 2015, that'd be great.
Okay.
I want to live trade it. That's my goal.
All right, yeah, and you had mentioned a manual aspect of checking for male or female, right?
Yeah.
Have you thought about maybe using Mechanical Turk on AWS?
Somebody else mentioned that as well. So it's interesting because the first pass I did on this, I used Mechanical Turk to get the start and end dates. I did a first pass on it, and then I got 3 Mechanical Turks to do passes on it, and then I just basically looked across them to get the most accurate ones to try and like validate that my dates weren't wrong. I hadn't thought about doing it from a gender perspective for getting the male-female thing, but that would be one way to do it. I love Mechanical Turk. Yeah.
So I think you may have addressed this already, but is there a way you can plot or find the variance around it, like run through a Monte Carlo or something like that? Just because you do have a smaller sample of female CEOs.
I'm sure you could. I don't know how. Thomas could do it though. But yeah, I don't actually, I haven't done that. I'm sure that you could look at it and try to figure that out.
Right.
All the data's available.
When is the portfolio size fairly static?
Aaron's asking, when is the portfolio size fairly static? So if you look here, this is 30 CEOs, that's 2011, so 35, 40, 45-ish. So it's still growing pretty rapidly. This is 2008 is actually more sizable than I thought. There's about 25 in 2007, 2008. So that's kind of how the portfolio size looks. I'm not sure at what point the portfolio is big enough to be interesting from that perspective. Yeah.
I have a couple of questions. How often did you rebalance? I mean, the number of companies kept increasing, and then how did the Sharpe ratios compare with S&P 500?
So my algorithm rebalances every time I make a purchase. So there are 80 different CEO turnovers. In the 12-year period, it rebalances 80 times. I've thought about doing one that rebalances monthly. I just haven't put in the rebalancing logic. The Sharpe ratios, so the Sharpe ratio of my algorithm is 0.6, as compared to the SPY over the same time period is 0.2. So Sharpe ratio, for those who don't know, is looking at the volatility of the strategy. A higher number is better. So my algorithm is less volatile than the SPY, but 0.6 is not a spectacular Sharpe ratio by any stretch. Really good hedge funds want like 2 or 3 as their Sharpe ratios. So it's a fairly volatile strategy, but it is less volatile than the S&P 500, which I'm pleased with. I didn't compare it to the Quanto 1000 yet. I haven't done the Sharpe ratio on that one, but those two, that's how that looked. Excellent. Thank you so much for coming to hear my story.